Welcome to our High Rock Weekly video. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. And we're going to chat about what we see happening in the global economy and in financial markets and the world of wealth management and how we are adjusting our investing strategy accordingly. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. Well, as you likely know, we have three models that we utilize to create our portfolio strategies. And Paul, any recent developments that you want to chat about today?
No, we didn't really do much across the week, Scott. Just within fixed income, we mentioned it last week. I think we talked a lot about it. Just preferred share switch, which we sold out of our rate reset, and we're in the midst of buying a fixed rate pref of the same name. So that really is the only change.
All right.
So that's short and sweet.
Yeah. Well, as you may or may not know, but last Friday, the U.S. Bureau of Labor Statistics announced the latest employment data for February, and stock markets took it positively. But as you can see, the month-to-month data can be quite erratic and is subject to some sizable revisions. So we like to follow the longer term, and the longer term trend in employment growth has been falling from its 2015 highs, even though there's a little bit of an uptick.
And Scott, is that what moving average is that? Is it?
That's a 1 year. That's a 1 year moving average.
Okay.
And as you can see, since about the last quarter of 2017 to the present, there's been an ever so slight updraft in that moving average, but really it's been holding pretty steady and still considerably lower than it was back in the beginning of 2015. So for all the talk, employment growth really hasn't been gathering a whole lot of momentum over the last little while. Now, we also watch and have talked about this many times in the past, but when the unemployment rate begins to rise and ultimately intersects the 3-year moving average, historically, a recession has followed soon after. And with the moving average continuing to fall and the unemployment rate staying at 4.1, the situation is now, the intersection is only about 0.6% away if we should start to see any shift in unemployment data. And now we do have the U.S. pretty close to full employment, so the likelihood of unemployment starting to rise at some point down the road is definitely not inconceivable. And given that we're expecting 4 interest rate increases from the U.S. Federal Reserve this year, we may start to see that situation evolve. So we're keeping a very close eye on that. Well, as I mentioned earlier, stock markets found buying support on Friday with the strong employment data and modest wage growth. And now we may see buyers looking to retest the highs. We showed this chart last week, and we showed the two arrows narrowing into a bit of a pennant formation. Well, we've broken out through the top of that pennant formation. So it remains to be seen what sort of technical buying follows along. But
Scott, it's also interesting to note on that chart that the Dow 30 industrial average did not break out of that sort of triangular pattern. Just the S&P and the NASDAQ did.
Right. And you know, the S&P 500 being a significantly broader index than the Dow, you know, Dow being an industrial index, so the industrials as they are called, yes, you're right. And but with the NASDAQ being inclusive, and certainly some technology companies in the S&P 500 have been certainly leading the S&P 500, right?
Yeah, for sure. And actually, I'm just looking as we're speaking, and the TSX is nowhere near breaking out of a similar looking triangle.
Yeah.
So.
Yeah, interestingly, we'll talk a bit about the Canadian employment data just in a second. But one of the things that we have talked about a little bit in the past has been the catalyst for the S&P 500 and other equity markets rising as they have really has been the fact that central banks at the very same time through the last just a little over 9 years, um, we've seen central bank assets globally move from somewhere in the vicinity of 4 trillion to close to 20 trillion, and three central banks in particular, the US Fed, the European Central Bank, and the Bank of Japan, have increased their balance sheets by a combined 15 trillion over this time. Now, the flip side of that, of course, is that all of the easing that they've been doing, the money that comes back into the financial system has, for the most part, been moving into equity assets, and is, for lack of anything else, we've seen the S&P 500 and other equity markets globally benefit. But eventually, Paul, and you can chime in anytime, but that money will likely have to flow back out as those central banks reduce their balance sheets, right?
Yeah, I mean, certainly the Fed's talked about it, but we do have to keep in mind that balance sheet, two things I would say on central bank balance sheets. Number one, they're infinite. They can grow as much as they want to grow. And the effect is obviously inflation, but that doesn't seem to be rearing its ugly head through the past 10 years, much to the chagrin of the central bankers. But the other thing we need to keep our eyes on here is that the reduction in even the Fed's balance sheet, and they've talked most vociferously about reducing their balance sheet, it's going to reduce really, really slowly. And as you can see, it's flatlined for the last number of years around the 4.5 trillion mark. So I don't know how much it's really going to decline, but the fact that I think everybody knows it's not increasing, and everybody knows it's going to shrink. The question is the calculus of the shrink. It's really not going to be enormous, I don't think.
But the European Central Bank and the Bank of Japan have really continued to buy bonds, and as a result, they're the green and the blue lines, while the Fed's the red line, which, as you said, is flatline, and as you can never slightly see it dipping. But the other two will continue to rise, and as long as that, I think, is happening, there's still going to be some underpinning for stock markets, and that's why we see this huge diversion between what's going on in stock markets, or in this case, the S&P 500 and the U.S. economy. We've shown this chart a few times over the last few videos, but that gap between economic growth and equity markets, which widened on the back of all this excess liquidity, it's not yet narrowing because, as you said, if you expect all of that central bank liquidity coming into the system to be inflationary, well, the first thing it's got to do is boost economic growth. But it really hasn't been doing that. And in fact, even in the first quarter of 2018, now we're starting to see the expectations for U.S. GDP have come down significantly from sort of the start of the period to currently. Now expectations are somewhere down from at the peak over 5% down to like 2.5% growth. So again, all of that stimulus doesn't seem to be impacting the global economy, but it's certainly having its impact on stock markets. So something at some point, I would imagine, is going to give, right?
Yeah, two things that the central bank liquidity was supposed to do was create inflation. I think central bankers coming out of the credit crisis 8 or 10 years ago were very afraid of deflation. So they were trying to get economic growth, inflation, and wage inflation. And, we don't have really stout economic growth. It looks like we have global coordinated growth at a much lower level than we would have had historically. And we don't really have inflation, and we don't have wage inflation. So I think it's sort of a Goldilocks type scenario right now for growth, stock stock markets and government bond markets. And I think that will probably continue for a little bit.
Well, it still doesn't help with the valuation of stocks, unfortunately. And
No.
the one thing that we have to be careful of is it's a bit like musical chairs, and we saw in February a couple of those chairs got pulled away, right?
Yeah, and it does create buying opportunities for those of us that are sitting on a little bit of cash.
Well, it creates angst though for those who are long of stocks, and when they get that significant kind of volatility too. Anyway, moving forward,
that's what we need.
What's that?
That's what we want, and that's what we need.
Yep. So let's talk a little bit about what's been going on in the U.S. yield curve. Certainly over the past week, not a lot. One thing that I know is going to start to happen, and we're starting to see it already, because the U.S. deficit and debt loads are going to start to rise, and they're going to be the U.S. Treasury is going to have to start to issue more and more bonds to raise cash to cover those deficits. What do you think that's going to do ultimately to the yield curve?
I have a couple of views on that. Number one, obviously, yes, there will be more supply, but I think a lot of that's baked into the market. And this week there is a massive amount of U.S. Treasury new supply, new issues coming. They've done, I think, 3-year bonds and 10-year bonds yesterday and today, and they were big size and they were received extremely well. Like the U.S. 10-year Treasury is 3 basis points stronger on the day, so or 3 basis points lower on the day, 0.03%. I think a lot of it's the supply is baked into the market. That's one thing. The second thing, actually, this Reserve Bank of San Francisco just put out a study today, and they finally admitted, and we do have this chart, maybe we'll show it next week. They finally admitted that the flattening of the yield curve, and this is the 2s30 yield curve, I believe, yes.
Yeah.
Is a very good predictor of the last 6 years of a recession. Now, you can see it's at 88 basis points today. It was a snick lower a month ago, but it has to get down towards 0 or even, in fact, negative before it really does predict the recession. So it's something we will continue to watch. But it is interesting that the central bank actually came out with that study today, because a lot of people are saying, no, it's different this time, yield curve doesn't matter, but it's mattered every single recession. So we will continue to watch, and I think it will have a flattening trend.
Yeah, and that's kind of something we've been monitoring and believing in for some time. And again, yeah, we'll be watching closely.
Oh, sorry, and Scott, one other thing on that too. There were a couple other central bank speakers today, and one of the other things they admitted was that raising two things, actually. Raising short-term interest rates too quickly will have an adverse effect on the U.S. economy. That was one admission, and that's part of the reason why the bond market did better today. And the second thing, and interestingly, and again, another chart we have shown in the past, and we could show next week, is they said that yields on U.S. Treasuries are now becoming attractive to the S&P dividend yield. And we've shown that chart a couple times, where you've got 2-year Treasury notes up around 2.25, and the yield on the S&P, the dividend yield in the S&P, is, I believe, somewhere around 180 or something, 1.8%. So interesting, these observations this afternoon from various Fed officials.
They've been listening to our weekly calls, obviously.
Good point.
Anyway, back to Canadian data. We saw the Canadian employment data on Friday as well. Slight increase, maybe even slightly less than expected after the big dip in January. It doesn't bode swimmingly for Canadian economic situation, but again, the Canadian yield curve, while it continues to flatten, it's still slightly above. Not dissimilar from the U.S., even though the spread between 2-year and 30-year Canada's is a lot narrower than in the U.S. The same kind of pattern, generally speaking. So again, keeping an eye on that. But I would suggest that we as we've been saying, given that the most recent budget from the government did very little to drive any economic growth. We've still got U.S. protectionist sentiment that we're concerned about, NAFTA not yet being resolved, and basically a stalled energy sector for the most part. Canada, as you've said, and we both agree, is probably in a bit of economic trouble at the moment. So while the U.S. Federal Reserve is likely to raise interest rates 3 or 4 times over the course of this year, we don't see the Bank of Canada really having the ability to raise rates anymore. I did read a report today that was put out that said, in fact, that the Bank of Canada may have to drop rates as we get closer to 2019.
Well, that won't be good for the Canadian dollar.
No, and that's another thing certainly that we're going to keep in mind. But that's going to be it for this week. I know Paul's heading out for March break, so I hope that anybody else going out for March break will enjoy it. And as always, if you have any feedback for us, please, by all means, send us your comments, certainly via email or phone us. But we will be back next week with another edition, so we look forward to seeing you all then.